The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A double dose of daily gains for U.S. stocks here on this Triple Witching Friday. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's take a look at where we stand on this Friday. Good news, the S&P 500 higher by about 0.9%. You can see that it's big tech really leading those gains. The Nasdaq 100 higher by about 1.2%. You can see the bond market a little bit of a sell-off underway. The 10-year Treasury yield higher by about 2-3 basis points. Right now, it's that risk-on mood really takes hold and also reflected in the VIX. Volatility draining. Romaine trading with a 15 handle, but 14 on the way.
Yeah, kind of interesting. You look at the moves in the S&P 500, a two-day 1.7% rally right now in the S&P, and that's just enough, just barely enough to negate the three-day 1.5% sell-off that preceded. While big tech is certainly a big factor, most of the best performers this week are decidedly non-tech. It's names like Moderna up a third day to the highest in 6 months, Carnival having its best day in 7, Albemarle reaching its highest level in 2 years, and it's Citigroup rallying a fourth straight week to the highest level since 2008, and even trucking company C.H. Robinson stringing together 5 straight days of gains to notch a fresh record high. This should be an encouraging sign of potential dispersion and a broadening of the U.S. equity rally in a week the Bank of America says saw the biggest inflow of money into U.S. stocks since a record $82 billion one week a year ago. Goldman Sachs strategists led by Peter Oppenheimer see the push higher extending into 2026 amid continuous earnings growth.
2025 has been a remarkably good year. It's been a year in which most markets have made very strong progress. And indeed, as we've been arguing, most markets have outperformed the US. And that's been the first time that's happened decisively for 15 years or so. But given the scale of the rises that we've seen, much of it coming from valuation expansion outside of the US, we would expect profits to be the main driver next year.
And the outlook for profits, at least here in the U.S., is optimistic and improving. Stocks with improving earnings outlooks have actually outperformed for months now. Investors rewarding those companies that give analysts reasons to keep raising those numbers. Earnings revision momentum, that's been the best performing market factor year to date, with the most notable brightening in financials, biotech, and entertainment. Katie?
There you have it. Well, let's talk about, of course, tech and value. We've been talking a lot about tech and those growth stocks driving a lot of the narrative and a lot of the gains this year. But then you take a look at the S&P 500, pure value, that's in white, versus pure growth, that's in blue. You can see that just slightly in 2025 over there on the chart that it's value that's outperforming growth, which is something that we talk about all the time, those growth stocks. The last time this happened was in 2021 that you had value beat growth on an annualized basis. Then take a look at what happened in 2022, a down year for both. So we'll see if this holds through the next week and a half or so, Romaine, and whether or not history might repeat here.
Yeah, let's get some insights out of our first guest. Kicking us off to the close here on this Friday afternoon, Stephanie Guild is Chief Investment Officer over at Robinhood Markets. Great to see you here.
Thank you for having me.
Let's talk about the momentum heading into 2026. We kind of know the backstory already for what led to the gains in 2025. Is that a repeat in 2026?
We've seen a little bit in 2025 of a broadening of earnings growth where it wasn't just wholly reliant on like the top 10 or the top 7. And I actually think that will continue where the gap between, the 10 and the 490s continues to close. And so when I was looking across my target and building that, I was going through each sector and what the earnings growth expectations were. And I actually took down the tech earnings growth a little bit just because I think there's already a lot of huge expectations built in there. And then I brought up some other ones.
What leapfrogs tech, if anything?
I'm not sure if anything leapfrogs it. It's just sort of like a lot of the other sectors that I increased a bit.
Yeah.
And so, for example, tech is 23% expected for next year, and I took it down to 18.
Okay.
It's still above its long-term average in the sector, but I just think there's going to be some other contributors. It's still a strong earnings growth year, right? But I just think that it'll be easier to beat in other sectors.
Easier to beat in other sectors. So that implies a bit of a catch-up movement from maybe some of the other players in the market than, tech necessarily being leapfrogged here. I wasn't sure what the past tense of that was.
That's what I mean, is that I think there'll just be better than expected earnings growth in other sectors relative to tech. That being said, within tech, I think you'll see some better earnings growth and some beating of expectations. And some of the names that maybe haven't been as strong, right? Like not necessarily the 100% AI-oriented ones, but call it the ones that have utility, meaning that they do something for you. You know, the Intuits and the Salesforces of the world.
And that expectation, are you seeing that reflected when you take a look at customer activity on Robinhood? Is there any story that, you know, folks are paying attention to other than AI at this moment?
It's a good question. I'd say not in the very recent, because our customers do tend to invest in things or buy more of things that are down a lot. And that's actually what we've seen is more the AI trade under pressure. So we did see over the last week buying of Oracle, buying of NVIDIA, and taking advantage of that downturn. But over the course of the year, we've definitely seen interest in the EV sector, which hasn't necessarily been the center of the world. You've seen quantum definitely be a strong sector. So it's just not very recently. It's been more AI.
Talk a little bit about healthcare, because we've seen certainly in the pharma side of it, not necessarily on the insurance side, but on the pharma side, we've seen a lot of activity there. In fact, some of those names hitting, if not record highs, certainly 52-week highs.
Yeah. It happened, though, kind of second half of the year. And it's something that we started in Robinhood Strategy, started buying more of and going overweight in October. And so you'll see, and I actually think it's part of that kind of AI getting into other parts of the economy rather than just being like a hardware and energy play, and being more of a play of like, how does it actually help productivity in general? And I think healthcare is the center of that, and Eli Lilly, for example, and some neuro, like bioscience areas as well.
I want to talk a little bit about how the Federal Reserve and monetary policy factors into your outlook. You know, we go back and forth, especially with market pricing, about how much Fed easing we can actually expect in 2026. You talk about this expectation for broadening earnings growth. How does the Fed factor in?
I think the Fed, the way I'm factoring it in is that I think we'll see a steeper yield curve, and thus short-term rates will come down, and that could actually help boost investment interest, because if interest rates on the short side, that's cash rates, come down, then you do want to sort of look for other alternatives, and that can end up being even more in the stock market. That being said, I think they're between a rock and a hard place. So I actually expect one more cut in January, which is odds have been rising a little bit, but still not the main expectation. And then I think there'll be a pause because you still have inflation is still like a thing out there. And even though inflation was lower in this past reading, it was only done from the second half of November. And so there's sort of still questions there. And I think the Fed has to think about the fact that the job market, while not as strong as it was, is not, I wouldn't call it weak yet.
Yeah, and when we call it weak, and it gets to this idea as to whether the U.S. growth story remains the primary growth story for the world. Obviously, we're the world's largest economy, so we're always going to be the focal point. But when you look at the outperformance relative to the U.S. this year of some emerging market assets, even other developed country assets, does it give you a sense here that the economic picture here will be more supportive of outperformance in 2026?
Meaning that does the U.S. outperform the rest of the world? It's something we've been debating on our team, to be honest, for a while. We have allocations to Japan, currency hedged, Europe, and China tech. And China tech is a little bit of a hedge within our portfolio, partly because, even if we think that there's a broadening of growth, we sort of see that tech is still going to be a dominant sector in the market and will still drive the market. And so we think that the only other place that can sort of compete with that is in China. And there's obviously some questions about investability that will continue to come up and create volatility. This past year, you had half of Europe's returns were really just from a currency, being here in the U.S. And so I'm not sure that you're actually going to see a ton of growth. It's hard to kind of see that in Europe. Japan is doing an interesting experiment, and that's where we've spent most of our time trying to debate, because in one hand, you have potentially rising rates, but on the other hand, you've got stimulus. And that's why we continue to actually play it in a currency hedge fashion.
All right, great stuff here. Great to talk to you. I guess we'll catch up with you in the new year, unless you want to come back during the holiday shortened week over the next couple of weeks. Stephanie Guild kicking us off to the close from Robinhood Markets on this last full trading week of the year. When we come back, we are going to talk about that outperformance overseas and, of course, some of the factors that drove it and whether that continues into 2026. Thea Jamison, the founder and managing director of Change Global, going to be joining us in just a second.
Plus, we continue to look to 2026, a year with big IPO expectations. We'll take a closer look at the incoming pipeline with Amy Butte. She is the CFO over at Navan.
And speaking of CFOs, we're going to get a view from the C-suite and IPO expectations from those folks who track all of those folks in the C-suite. A breakdown with the co-founder of Teneo, Paul Keary. That's coming up in just a bit, right here on The Close, right here on Bloomberg.
Well, emerging markets have had a great year, outpacing the S&P 500 as investors sought out gains on a global scale. Our next guest says that we're in the early stages of a new bull cycle for emerging markets. Joining us now, I'm pleased to say we have Thea Jamison. She is founder and managing director of Change Global. Thea, it's great to see you in person.
Hi, Katie. Hi, Romaine. Good to be back.
So let's talk about that, because in your notes, you highlight these early stages, a new bull cycle. We've been hearing these calls for a while now, but in 2025, it seems like it actually played out. So talk to us where you see the momentum continuing into 2026.
I mean, it's been an incredible year in emerging markets, up 30% so far this year versus 15 or so for the S&P. So big outperformance. And we think we're in the early stages because all the stars are aligning. We're seeing improvement in the fundamentals on the ground. We're seeing signs of a shift in flows. And certainly this outperformance is supported by very compelling valuations.
Absolutely. And it's tempting to talk about EM as sort of a block, but where specifically in terms of regions, in terms of countries, are you seeing the opportunity right now?
I came back from the Middle East recently. Absolutely phenomenal trip. Being on the ground is just so incredibly helpful. And I can tell you that it is the most dynamic region globally right now. And that's driven by population growth, immigrants, particularly from Europe, moving to the Middle East. It's driven by massive investment in AI and tech infrastructure to drive productivity. And it's driven by a real focus on bringing in investment and developing the capital markets.
Can you give me a sense here of where you specifically see opportunities, though, in terms of what you want to invest in that space? I mean, we can take AI data centers. We've seen the big build out, Stargate, and some of the other big projects that have been announced. Is that most attractive to you right now?
It is incredibly attractive in the UAE, and that is because it's a way to drive productivity. It's real. I visited with the investors and the local authorities that are participating in this build out. Just to give you a reference, the new AI data center is intended to be the largest outside of the US at 5 gigawatts. It's currently underway and all the big tech names are participating. And the intention there is much more than just providing data to the UAE or even the region. If you look at the low latency reach, they can reach roughly 4 billion people. So it's massive. They have the power, which is cheap. They have the land, and now they have a plentiful of labor as well.
What is sort of the push from the top down to accelerate these projects? Obviously, a lot of people are looking around the globe as this being an AI race, what the U.S. is doing, what China is doing, what Europe may or may not be doing, and of course the Middle East here. Do some of these Middle Eastern countries have an advantage over the others because of the more top-down strategy to this?
Yes, I mean, definitely, in particular to the UAE, their government is considered as very stable, as trustworthy, and a good neutral partner to the East and West. So combined with the cheap power, solar, as well as land and access to talented labor, there's very limited pushback, particularly in the UAE.
So the Middle East, high conviction for you heading into 2026. Where else? You know, when you think about the whole scope of the globe, I know that this isn't in emerging markets, but I see that you highlight Europe in your notes as, you know, a place that you visited recently.
So a big part of Europe, Central and Eastern Europe, is still considered an emerging market.
True, fair point.
And Poland is right in the midst of it. It's a significant economy with a significant stock market. And Poland today is by far the most dynamic country in all of Europe. The economy is growing at 3 to 4%. Historically, it was counter-cyclical because of the attractive labor costs and business regulatory standards. However, as of late, there are some cyclical drivers, and those are the massive EU infrastructure funds to modernize and digitalize the economy, as well as a very intentional focus on driving liquidity from the banks to the stock market. In Poland is truly an outlier. Over 50% of household assets are laying in bank deposits. So the local government is very intentional and thoughtful about moving that liquidity into the stock market.
I'm curious to get your just outlook for the dollar, because obviously a lot of the outperformance that we've seen, particularly in Europe relative to the U.S. and EM relative to the U.S., has been partly because of the weaker dollar and the effect that that's had. Does that continue into next year? Are you anticipating that softness to be there?
So we're definitely seeing some signs of global flow realignment. For example, looking at deal activity on a year-to-date basis, of course, the U.S. is at the top with roughly $118 billion. But if you look at 6 of the top 10 markets are emerging markets, and the combined deal activity in those 6 is roughly the size of the deal activity in the U.S. So we're definitely seeing some signs of that realignment, and that could go a long way. Another way to kind of look at that is the net international investment position of the U.S. is roughly at $26 trillion, which means a small shift back to those markets. Let's say we take 20% of that, which is roughly $5 trillion. That is equal to the entire free float adjusted market cap of emerging markets. So it could be very meaningful going forward.
All right, Thea. Well, we have to get you back on early next year to kind of kick us off right and see how things goes. Putting a lot of frequent flyer miles on her card here. Thea Jamison is the founder and managing director of Change Global. As we continue to count you down to the close here on this Friday afternoon, a closer look at airline and travel stocks ahead of next week's holiday travel rush. A closer look when we come back here on The Close, here on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. Let's start with Birkenstock. Williams trading downgrading to hold, slashing the price target to 51, citing a disappointing earnings report last night, coupled with a lack of clarity from the company's management team. The analyst says that makes this a tough stock to own. Nevertheless, the share is getting a modest bid on the day, up about 2.5%, though still headed towards one of their biggest weekly drops in more than a year. Next up, Lyft. Wedbush hitting the brakes on the ride-sharing company with a downgrade to underperform. The analyst says Lyft is most at risk to the impact from autonomous vehicle disruption. Those shares moving lower here towards their second week of losses. And finally, Lockheed Martin. JP Morgan downgrading the defense contractor to neutral, but it is bumping the price target up to about $5.15. The analyst still has concern that parts of the company's portfolio face top-line challenges with execution by management inconsistent. Those shares up on the day, but still down on the week, and those are some of our top calls. We do stay in the aerospace space and take a closer look at airline stocks on this day as millions of travelers prepare to take to the skies for the Christmas holiday week. Let's discuss this a little bit more with Tom Fitzgerald, Vice President of Equity Research at TD Cowen, covering airlines. All right, it's been an interesting year for airlines because we kind of came in, I think expectations were pretty low. They kind of surprised to the upside, and then you had some pretty aggressive forecasts come out, at least out of a couple of the airlines, kind of mid-year or so. Where do we stand now that the year is over and we're looking into 2026? Are the trends as sort of the tailwinds from this year? Is that the story for 2026?
I think it is, yeah. I think we get the year that we hoped we had this year. The sector is going to be lapping favorable comps for most of 2026. Fuel prices are easing, which is favorable. Supply growth looks fairly rational to us, and demand's hung in. Premium's been strong all year, and we think, especially with the strong tax refund season, we could see the lower end perform well again next year too.
Talk a little bit more about that lower end, because it seems like nobody wants to do the lower end. I mean, we have Southwest on the screen, which used to be a bargain airline, and now they're even getting into that fee-tiered structure. Delta, American, every time you talk to them, all they want to talk about is the premium part of the cabin. Who's left? Who's actually catering to the lower end environment?
I don't think it's as much as no one wants to cater to them. I just don't think we need so many distinct carriers that only cater to them, and I think we can almost have airlines for all seasons, and with the revenue segmentation, the full service carriers can provide with business travelers, people in the middle, and people who are price sensitive.
Well, it brings up the question, Tom, will we ever see some industry consolidation here? We know that there's been attempts famously in the past that haven't exactly gone through. Looking forward into 2026, is that a conversation actually worth having?
I mean, it's something investors are watching, I think, in the ultra low cost space. We'll see what happens there. I think regardless of all the scenarios, it's likely that supply continues to be rationalized. I think at the larger end, it's pretty much set with the big six right now. But I think the industry is probably the most investable it's been in some time with the economy hanging in, rational supply, and I think margin's going to be moving up for the years to come.
Well, to that point, one of the bullets in your note is that we view the sector as broadly under-owned heading into next year. Your top pick and your best idea for 2026 is United Airlines. Tell us why.
There's not a lot of stocks that are going to give you, 20+% EPS growth with a path to double digits for the years beyond that are trading at a single-digit PE multiple right now. I think they offer one of the only attractive, growth at an attractive price right now. They have a nice flywheel with their fleet investments that enable better revenue production, non-fuel unit cost reduction, and a better customer experience. So that's driving significant share gain, significant margin expansion, and it's a win-win-win for customers, the business, and shareholders.
With regards to Delta, I mean, where do they sort of fall in this stack? In terms of how you rate them?
They're always the margin leader. I think sometimes by being so good, there might be less upside on the stock perspective, but they're our second best pick. We think they're a great company. We definitely think the two of them are worth a look for S&P 500 managers in the next year.
And Tom, I'm looking at your stable of coverage. I can see that you mostly have buys. You do have two hold ratings. That is Southwest and that is JetBlue, both rated as hold. Tell us why. And, do you think that do you see any potential that could change in 2026?
It's a great question. JetBlue, we've been impressed by the turnaround so far. What gives us pause is the leverage. They have the most leverage of the six major U.S. airlines. Southwest is really interesting. We did recently take up our estimates. It's harder to underwrite upside from here, just given the inherent lack of visibility in the industry. We could become more constructive if they continue to surprise to the upside. The big swing factor is going to be how their new premium seating performs and what payload factors looks like as that product ramps next year.
Absolutely, Tom. Great to get a preview of the year ahead with you. That is Tom Fitzgerald. He is VP of Equity Research over at TD Cowen. Certainly an interesting conversation. Heading into the holiday season, we know that certain airlines have been plagued during this period. Yeah, plagued during this period. And honestly, I'm just thankful that I don't actually have to fly this holiday season. But yeah, I mean, it's been an interesting year. And they have stepped up, certainly you've seen that on the premium side, whether it's the business class or the premium economy. Question is, like I said, what about the people who just want to save a buck? What about the back of the plane? We won't have that conversation coming up, but coming up, we will be talking to Amy Butte. She is the CFO of corporate travel platform Navan. She joins us next. This is The Close. Are in the back of the plane. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick. And I'm Katie Greifeld, keeping an eye on markets on this Friday. Maybe we will go positive, but we're also keeping an eye on IPOs because somehow, Romaine, it has been a big week for IPOs. It's a big week. I mean, obviously, Medline, the biggest IPO of the year, and probably more importantly, not a tech IPO. Yeah. You would expect a tech IPO to be up there, basically an old economy type of company going public. And also, I think it was the biggest private equity exit, at least an IPO-backed exit, in history. Yeah, certainly says something there. Also, somehow the largest U.S. listing since Rivian in 2021. An amazing fact in and of itself, but also amazing when you consider it's not a tech company. So yeah, it's like, gloves, gowns. I told you I still have little blankets and stuff that you put on babies in the hospital. Anyway, for more on IPO momentum, let's discuss with Amy Butte. She is the CFO of Navan, which just went public in late October. And we want to talk, of course, about Navan's most recent earnings, but we also want to talk with you about just the broader IPO momentum that we've seen. You have an impressive resume in this space. You helped, shepherd in the IPO or the public listing of the New York Stock Exchange. So what do you make of the fact that the final full trading week of 2025 had such big IPOs come through? Companies are ready to go public, right? We talked the last time I was here about the pipeline, and companies benefit from
the marketing, the branding, they benefit from access to capital, they benefit from having an acquisition currency, and they just benefit from being public, and it's good for the capital market. So I think the strength at the end of the year shows there are companies that have been ready, they've been in the pipeline, and at different times there's appetite. We have seen, however, the fact that investors can be fickle, right? They can be very quick to be risk on or risk off. We were looking at some data recently that tech IPOs between April 1 and the end of October were up 76%. And those same tech IPOs from end of October to just end of day yesterday were down 30%. Wow. So it's probably the first asset class, new IPOs, to be sold down or to be bought in, depending on just the general sentiment in the market.
Yeah, I mean, I feel like CoreWeave is a great example of that trend. It absolutely soared after its IPO up until June, and since October, pretty much, it's kind of been in the dumps. So the fact that you do have this sort of hot and cold attitude to the new tech entrants, is that something that, we might expect to see continue in 2026, or could this just be a moment in time?
I think it's a moment in time, and I think we'll have the same moment in time again in the future, just like we've had it historically. I mean, my sense is, though, that bigger IPOs are coming, not just this week, but when you look to 2026, there's some really big names that are ready to go out.
Well, can we talk about how that gets digested by the market? And obviously, for those folks who don't know, but in your previous life before Navan, I mean, you were instrumental in bringing a lot of stuff to market, including the NYSE itself, which is sort of apropos. But you look at the size of OpenAI, Anthropic, and SpaceX, I'm forgetting a couple others here, Databricks. You're talking about companies that are going to be, in some cases, close to $1 trillion valuations. The only thing we could find that even came close to that was, of course, Aramco. And they sold such a small sliver. Is that what we're going to be looking at?
I don't know. Yeah. I don't know the exact number. But when companies go out, they're really trying to manage the size of what they bring to the market. That way you can have the right supply-demand dynamics and making sure that there's enough for the portfolio managers to put in their portfolios, but not too much. They're trying to manage the float. They're trying to manage secondaries. So all of it, it's a lot of calculations that go into it. But as you said, it's really about making sure there's the right supply-demand at the time of the IPO.
But do you think something like an OpenAI is almost more difficult? Because on the surface, you would think everybody wants to own it. But I almost feel like then that almost creates a potential for error of overshooting, for the bankers to overshoot expectations given all the hype.
Sentiment drives a lot of demand, right? Or it can lead to lack of demand. And so I actually think something like OpenAI will probably be viewed as something that has to be in the portfolio. And that's part of it as well. Yeah.
And that's been an argument, too, with some of these big names, is that given how big they are, most of them, and the fact that they're all, most of them are cash flow positive, they're probably going to end up in the benchmark indices within a year or so.
Correct. And you also have the fact that, portfolio managers are looking for new names, particularly in large cap portfolios. They're looking for new names to add to diversification. Think about how many names or how much market cap has come out of the market over the last few years. And so these IPOs are really well received, as long as it's a story they can understand and a story they want to put in the book.
Well, that's one of the big conversations, the shrinking supply of the public equity markets, and maybe you're especially feeling it in the large caps. And I wonder, how far we can take the example of OpenAI, of SpaceX, and extrapolating that to this narrative that's prevailed that, you can stay private for a long time here. You can get all the funding you need. Do the possibility of OpenAI and SpaceX going public actually dispel that, or are those such special cases that maybe it doesn't quite apply?
They are special cases. At the end of the day, they are special cases. On the other hand, I think they're realizing the benefits of the public capital markets. I mean, many of them are the big names are issuing debt, right? And it's easier to do that as a public company. They realize that their employees are looking for a secondary market for their shares. And I also believe it's part of a general maturation theme that these companies realize, whether you're private or public, you need that maturation, and going public really can be a forcing function.
So, Amy, before we run out of time, we do have to ask you about the actual company that you work for. You are the CFO of Navan, which just went public. For those of viewers that don't know, basically business travel application. You're also leaving next this year, some time away from your position as CFO. Give us a sense, first of all, into how Navan's business is doing, and also more specifically some of the broader trends with business travel.
Sure. So thank you. We reported our first earnings this week. Revenue was up 29%. Our gross booking volume, which is the number of transactions that people are spending on, grew 40%. Our gross margins expanded to 74%, and we had almost 900 basis point expansion in our non-GAAP operating margin. So basically what it says about business travel is that it's booming. We actually had a record month in October. So a lot of people are wondering what happened during the uncertainty of the government shutdown. Road warriors are road warriors. We had a slight pickup at the end of October. Basically, I think everybody trying to get those trips in before that November 11th date. And then we saw a little bit of a slowdown versus what we normally see. And, you know, they're right back at it. So it's great to see business travelers continuing to travel.
That is so interesting that even during the government shutdown, when there was a lot of concern about the functioning of the airlines, that, as you say, the road warriors still traveling. It's interesting taking a look at the sell side reaction. We don't have a ton of time left, but there is this idea out there that the guidance was a little bit conservative, and I wonder if you agree with that assessment.
Sometimes it can be wise to be conservative when you first come out with your first earnings. But I will say the momentum in the business is incredible. We're seeing enterprise customers really at a tipping point of recognizing the importance of AI, modern technology in their stack. Corporate boards, CEOs, and CFOs are realizing that benefit. And we saw new customer announcements, a CAC 40 company. We saw Axel Springer, Frasers join us. We launched Visa this month. And so we're really excited about the momentum that we're seeing. Travelers want that AI edge.
All right, Amy, I have to leave it there. Great to talk to you.
Thank you
We'll
so
catch up
much.
with you in 2026. Amy Butte, CFO over at Navan. When we come back, Factor Friday with Chris Cain. Stick with us. This is Bloomberg. Time now for our Factor Friday, monitoring the key catalysts moving the markets this week. Chris Cain of Bloomberg Intelligence joins us to walk us through what he's been keeping an eye on. And Chris, I mean, take the traditional factors off the table here. What's really the one that's been driving the markets most?
You know, one of the non-traditional factors that we've kind of been following all year and has really worked all year is EPS revision momentum. So how you form this factor is we look at how has the forward quarter EPS expectations changed over the last 3 months, and that's using analyst estimates or Bloomberg best estimates. So, you know, the high EPS quintile within the Russell 1000 has beaten the low EPS revision quintile by over 22% over the last 18 months. So it's really driving a lot of the equity gains in the cross section. And, you know, it's not just the last 18 months. This factor has worked really well over the last 15 years. Again, high EPS revisions are up about 900% since 2010 compared to just 250% or so for the low EPS revision. So we definitely think, you know, this is kind of a non-standard thing that people should focus on.
Well, let's talk more about that high EPS revision cohort. What sort of sectors actually populate it?
Yeah, Katie. So, you know, we do this what Quant would say non-sector neutral. So that's just a fancy way of saying, you know, just the highest EPS revision momentum stocks are in the highest quintile, no matter what the sector is. And we think there's information in, you know, how many stocks per sector make that group. You know, right now I would call the high EPS revision portfolio very cyclical, not defensive. So tech puts the highest percentage of the sector in that group, so about 34%. Sectors like real estate and financials are as well overrepresented. And then kind of the more defensive sectors, things like healthcare, materials, staples are underrepresented.
So talk about how you kind of characterize in the current group of the high sort of EPS revision stocks from the traditional factors, Chris.
Yeah, you know, when we do a non-traditional factor, we always look at what loadings are on the traditional factor. So said kind of like not in quant speak, what are the characteristics of this high EPS revision portfolio? So right now we would say The high EPS revision portfolio has higher volatility than a typical stock in the market, higher price momentum, higher earnings growth, and that's past earnings growth, as well as higher valuations are more expensive. And when you look at it through this lens, some of those factors are really the factors that worked well this year. Specifically, high volatility has beaten low volatility, high price momentum has beaten low price momentum. That's congruent with this high EPS revision portfolio, and we think that's really driving a lot of the outperformance on the year.
And we have less than a minute here, Chris, but given that it is the final full trading week of 2025, we were showing this chart a little bit earlier that you take a look at the scope of the past year, that value, pure value, is actually outperforming pure growth. And I would love to hear your thoughts on the significance of that stat.
Let's just hope it's the beginning of a rotation, Katie. I'll say that. Value has really woken up over the last couple months. We've made the point many times that value is very, very cheap. Obviously, cheap stocks are cheaper than expensive stocks, but now they're way, way cheaper. And that's really a function of, underperformance for years. So, historically, when we've had a setup like this, it's been good for value. We've seen value do pretty well over the last couple of months. Like you've said, it's up on the year now. So hopefully that sets us up well for 2026.
Yeah, it'll be interesting to see if that outperformance hold those two factors neck and neck. Chris, great to get some time with you. That is Chris Cain of Bloomberg Intelligence. Meanwhile, we're counting you down to the close. And coming up next, David Bianco. He is America's CIO over at DWS Group. That conversation up next. This is The Close.
The gap between, the 10 and the 490s continues to close. And so when I was looking across my target and building that, I was going through each sector and what the earnings growth expectations were. And I actually took down the tech earnings growth a little bit just because I think there's already a lot of huge expectations built in there.
Stephanie Guild over at Robinhood Markets kicking us off to the close just about 50 minutes ago here on the final trading day of the last full trading week of the year. And it looks like we're going to end on a high note, Katie Graffeo.
Which is interesting. It's been a really rocky week, to say the least. But you take a look at where we stand on the S&P 500 after this big rally that we're seeing today. We're just about in the green for the S&P 500. The NASDAQ 100, meanwhile, is leading a lot of those gains. Your big tech names, the NASDAQ 100 higher by 1.3%. The bond market, a little bit of a sell-off right now, but you can see the VIX certainly trending lower. We're getting closer and closer to breaking 15. Yeah, closer and closer to breaking that here, and it raises a lot of questions about the momentum going into 2026, with the S&P sitting on a 16% year-to-date gain, the NASDAQ up more than 20%, and big questions about what drives, if at all, that rally over the next few months. David Bianco joins us right now. America's CIO at DWS Group joins us here in Studio 2. Let's start off with the backdrop heading into 2026. What's going to be most supportive, in your view, for additional public market equity gains?
We're not going to have a recession, even though the unemployment rate does stay high. It's already up a half a point over the past year, and it may go up another 1/10, 2/10. Not sure we'll call it a jobs recession, but it's going to be a soft labor market, and a bunch of reasons for that. I don't think the main reason for that is where the Fed funds rate is, but we'll find out that the economy is still resilient. Consumer spending, it will be healthy. The consumer, they always spend, and in the springtime, there will be a lot of stimulus coming from One Big Beautiful Bill, and we are expecting tariffs to be refunded to the importers of record. So about 3/4 of a U.S. GDP point will be, you can call it unofficial stimulus from some of those things happening around tax refund season. Now, the S&P 500 isn't all about U.S. GDP, so there's still a lot about tech. And we have to make sure that capital is free-flowing to keep building these data centers.
I just want to just stay on the macro for just one other second. And on the inflation side of this, and right now we should just point out Kevin Hassett, economic advisor, speaking right now, potential Fed chair, depending on who you want to believe. He's making a lot of comments about inflation, basically saying that inflation right now is basically where it needs to be. That in his words, he thinks that inflation will be at or below the Fed's target, and he basically expects the numbers, in his words, to stay roughly where they are right now, like this, where his exact words. Does that make sense?
Where inflation is right now is still above target, 2.0%. I do think there are some reasons to believe that inflation continues to work its way down, disinflation over the coming year. But this is 5 years now of inflation being well above the Fed's target. So hopefully this Fed and next Fed leadership don't take this fight for granted. I think everybody also knows the deficit is very high.
Yeah.
And the tariff revenue is not a reliable source of revenue on this front. So I think when you've got a time when we need to keep long-term bond investor confidence and dollar investor confidence, now's not the time to give up on the inflation fight prematurely. The labor market's soft for reasons that I could elaborate on. I don't think another 25 or 50 basis point cut really changes that situation too much.
Well, David, I was going to ask you where all of this leaves you on the bond market. As you mentioned, this is a really important time to keep investors' faith in sort of the long end of the yield curve. Do you have that confidence?
So our view is that the 10-year yield stays really where it is about now, 4.15 by the end of the year, but we're paying attention to the entire shape of the curve. And as I focus on equities, there's a lot of still, even though beyond tech, there's still a lot of importance for interest rates. A lot of investors in real estate and housing-related stocks, they want to see long-term yields fall. Banks, they want to see a steep curve and an even steeper curve, and I think they're going to get that, and that's really good for the banks, and that's our favorite sector into year-end and early next year. But the entire S&P 500, excluding tech, is still a high PE, very high PE versus history, and I think equity investors would like to see interest rates across the curve come down, and that requires that the Fed cuts at the right timing, at the right magnitude, and the 10-year yield comes down maybe a little bit more from where it is now as the Fed cuts, but they shouldn't be in a rush to do that in my view.
Well, let's draw that out a little bit more. So, you think about how the shape of the curve might develop. That is one of the reasons why you're positive on financials. But you mentioned, that wouldn't be a great environment for some of those housing-related stocks. So does logic then follow that maybe those are some of the areas that you're staying away from?
Well, we prefer them less. So there are domestic plays like financials and housing stocks and many retailers. We prefer financials as a play on the U.S. economy rather than consumer goods or housing. But the other part of the U.S. economy that we think is resilient and good for profits, we do believe this data spending will continue. So electric utilities, electrical equipment, that's something that we favor as a play on U.S. investment spending. I don't think it's that interest rate sensitive, but if we can get some lower interest rates, I think a lot of capital, private credit, public listed debt will flow toward building the data centers.
But how much lower can they really go? I mean, based on the economic data we have, I mean, you could actually make an argument for not cutting rates. And even if you look at the data that we have and say, yeah, this warrants a rate cut, I don't know if it warrants like, a full, 100 basis points, maybe a quarter here, a quarter there. But you have people predicting 4 or 5 rate cuts next year.
I agree with your perspective. I just think they need to take their time on this. We all look at history over the past 20 years before the pandemic, and that history would suggest there's plenty of room to cut interest rates. But the inflation experience that we've gone through the past 5 years and this deficit and the changing nature of the world economy with us buying Asian exports and they buying our treasuries, a lot of things have changed. So I think we need to go careful and, as I said, focus on keeping the long-term bond investors' confidence over the full course of the year.
And we don't have much time left, but I do spy this line in your notes that you're also underweight energy and materials. Talk us through that a little bit. Those less preferred sectors, as you phrase them.
That's right. Ample supply, particularly when it comes to oil. I believe that the future of energy is electricity, not so much oil, but natural gas is a big play on that. So if you can pick your spots in oil services, energy services, and natural gas producers, then we see some upside. But the future is about electricity.
There you go.
All right, David, always a great conversation. David Bianco is America's CIO over at DWS Group, helping us count you down to those closing bells. 2.5 minutes to go. Katie Greifeld, an up day, and we should point out just maybe enough to push the S&P into the green on a weekly basis, but barely.
And we should point out, too, that volume is pretty high today. We know that we have a lot of options expiring today. Triple witching, very spooky. And this is the period where you would expect to see that volume come through.
And, of course, could potentially be the last hurrah for the year on the final full trading week of the year. A full breakdown comes now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Graffeo here to take you through to the closing bell with a global simulcast. We're joined now by Carol Massar and Tim Stenovic in the radio room. Welcome to our audiences across all of our Bloomberg platforms as we parse the most crucial moments going on in the world of finance. But we do want to start off the simulcast here with a note here about the world of politics. We're now learning, based on a headline crossing the Bloomberg terminal, that some of the Epstein files have been posted on the Justice Department's website. Here is what we know right now. The president, of course, last month signed a law, a bipartisan law, requiring the release of files related to financier and convicted sex offender Jeffrey Epstein. We are talking thousands, hundreds of thousands of files. This is a significant amount of data, so we are having our team parse through all of this as we speak. And as soon as we get details, and more importantly, a deeper understanding of what's in this report and the implications, we will bring it to you and break it down for you live on air. But right now, some of those files now being posted to the U.S. Justice Department's website. Carol?
All right, good to know, Romaine, and obviously we'll continue to monitor that. In the meantime, we've been monitoring the last Friday full trading week of 2025. There's more trading to go, of course, but we are seeing a rally underway. Right now, we're looking at stocks kind of hovering near their best levels of the session still, up 0.8%, almost 0.9% on the S&P 500, 68.34. NASDAQ 100, a gain of more than 320 points, Tim, up 1.3%.
We get the closing bells here in New York on this Friday afternoon. And it has been quite a week here. I do want to start with the S&P 500 because it's up right now, roughly about 58, 59 points as we wait for these numbers to settle. That's going to be about a 0.9% gain on the day, 68.34 and change. Looks like where it's going to settle. And if it holds that means that we'll have effectively erased all of the losses from the first 3 days of the week, providing a weekly gain for the S&P. Only up about 0.1%. But that is a big turnaround from where we were earlier in the week. The Dow Jones Industrial Average adding about 182 points on the day, or 0.4%, is still going to finish the week in the red. The NASDAQ, though, inching into the green on the day and on the week, a 1.3% gain for the day. Similar gain for the NASDAQ 100. And the Russell 2000 on the day adding about 22 points, or about 0.9%.
All right, and going back to the S&P 500, if I may, 284 names to the upside, 217 to the downside. Despite that overall index move, you are seeing, Katie, kind of a split in the winners and losers here.
Let's take a look at the sector breakdown as well. Certainly informative today. You can see visually represented a lot more green than red. That's because a lot of the biggest sectors outperformed today as measured by tech. That sector higher by more than 2%. A big rally underway in shares of NVIDIA today, but also financials, industrials, healthcare getting in on the action as well. So some breath there. In terms of what didn't perform on this Friday, on this final trading day of 2025, consumer discretionary.
Final trading day of 2025?
Of the last week of 2025.
Oh, okay. You had me scared there.
No,
Yeah.
don't worry.
Right.
We still have plenty of time left together. Anyway, utilities up by 1.3%. Consumer staples down about 0.5%, Carol. Real estate also getting hit today.
I gotcha. All right, let's get to some of the individual gainers, if we may. Carnival, this was definitely an outperformer. Number one gainer in the S&P 500, folks, just finishing off its highs of the session. Still good enough for a gain of about 9.8%. The company giving a better than expected profit outlook for next year, reinstated dividend payments. The company expects adjusted net income to rise about 12% next year. That's higher than the average analyst estimate of an 8.7% increase. So that's quite some outperformance there. As we mentioned, they also announced that quarterly dividend, 15 cents a share after payouts were discontinued back in 2020. Company also said trends are poised to continue to next year on higher prices and bookings. So that lifting the cruise group on this Friday. Got to go over to Oracle, which has had a little bit of a tough go as it questions some of its moves and investments into AI and the debt that it's been taking on as a result. Actually getting a kick to the upside, up 6.9% in today's session. This happening on a Bloomberg exclusive, TikTok being bought by a group of buyers led by Oracle, which will own 15% of the entity, as will Silver Lake and MGX. That's an Abu Dhabi-based investment company. Oracle and ByteDance signing binding agreements to create a U.S. joint ventures. And so it will be an independent entity controlling data protection, content moderation, and algorithm security with a new 7-member majority American American board of directors. So that was some interesting performance there for Oracle. And this one, for something different, I like to kind of go there. A small market cap, about $617 million. Ticker is WYFI, White Fiber. It was spun out this year from its parent company, Bit Digital, which is a crypto firm, which spun it off to focus on AI infrastructure. White Fiber provides AI data centers with what's known as biological white fibers for quick power and fast computing needed by AI and machine learning tasks. And what happened is some news today, it announced a 10-year, 40-megawatt co-location agreement between its subsidiary Navan Data Centers and N-Scale Global Holdings. There's a lot of stuff in here, but basically a new megawatt data center. What's interesting is it takes kind of existing facilities and makes it ready for high-performance data center compute, if you will, that's needed for AI, machine learning, and all that good stuff. So I just like to throw that out. It's a stock that is down about 5%, though, since its IPO back in August.
Okay, that one, I have a less complicated one, Carol.
Sorry.
I'm going to start with that.
Bring it home, Tim.
Everybody knows what Nike does. Down
educate.
10.5% today. This after the company warned that sales will decline this quarter. Persistent weakness in China. And then the Converse brand also seeing weakness, too. The company does expect revenue to be down in the low single digits in the 3 months that started on December 1st, with Converse sales plunging and Greater China sales down. Nike shares today down by 10.54%, kind of where they were throughout the session. Also, Lamb Weston. Oh,
wow, what
frozen
happened?
potato French fries. Frozen potatoes
as
French
opposed
fries.
to
Look at this.
non-potato French fries.
You could have some
You can have sweet potato
French
fries. Yes, very
Yeah.
valid point.
You know.
Those aren't real fries, but thank you. All right.
Okay. Down
It's the
26%
hill I'm
today.
willing to die on.
This is now trading at the lowest going back to March of 2020. The company came out and maintained their full year guidance despite beating second quarter expectations. The company noted, though, in their press release that the price mix declined 8% in North America due to ongoing support of customers through price and trade. So essentially a profit warning about discounting and rising manufacturing costs. And finally, looking at home builders, specifically KB Homes today, this after a week where Lennar reported results that disappointed markets too. KB Home shares fell down 8.5%, at one point down the most intraday since 2020. This after the company posted fiscal fourth quarter profit that missed analyst estimates. The midpoint of the outlook range for fiscal 2026 housing revenue also lagged expectations. KB Home down 8.5%.
Well, let's take a quick check in yields. The entire curve shifting higher on the day, but we should point out pretty much every key point along that curve is lower on the week, including your 2-year yield, which is higher on the day, but is now dropped for 2 straight weeks as a lot of people continue to bet on continued Fed rate cuts into 2026.
Yeah, and that's going to be our big thing. You know, what's interesting is we've been talking a lot here, Tim and I, and I'm sure you guys have too, about some of the inflows that we've seen into U.S.-based assets and U.S. stocks in particular. We ended last year wondering whether U.S. exceptionalists would continue exceptionalism. It did in the beginning of the year. That changed then with Liberation Day and the tariffs by President Trump, but we've seen investors coming back into the U.S. market in a big way, and I think that's interesting. Does it hold in 2026? Who knows?
But as we spoke about with Eric Wiener a little earlier in our program, the U.S. performance kind of pales in comparison to some of the performance that we've seen elsewhere in the world. Europe as a whole outperforming some countries there, Lithuania, Tunisia, Jordan, Slovenia, up 50%. Venezuela's stock market up more than 1,200% this year. We're not at the end of the year yet, but we're seeing where the U.S. fell in this year's trade.
It is really fascinating to take stock of some of those stats, because I remember having this conversation in January, February, that fledgling outperformance you were seeing from the rest of the world. A lot of folks said it was basically a false dawn, that we've been in this movie before and it tends to be fleeting, but I don't know. Yeah. Performance is proof, and it's been a solid year of this. So it is going to be interesting to see whether that momentum does continue next year, and what is the catalyst?
Well, it's also interesting, too. I mean, we can't really talk about that outperformance without talking about the massive drop that we saw in the dollar this year, at least if you measured by the Bloomberg Dollar Spot Index, down, I think, we're at about 8% or so, which is kind of the worst year, at least since 2017. And it's a complete flip-flop from what we saw last year, when we saw the dollar actually appreciate by about 8% relative, at least to its biggest peer. So that's going to be a big factor, Carol and Tim, as to whether that continues.
All right, so I'm looking, let's see, the next Fed meeting in 2026 is January 28th. And then
are we going to be close to a government shutdown by then? That's the question, too.
Wow.
And then you got JP Morgan earnings on January 13th. So I just feel like, Are those our next focal points?
Oh, okay. You're going deep there. Okay. All right. Christmas is next week, by the way. Merry Christmas.
Always thinking
Merry
about
Christmas.
what's coming. All right. Merry Christmas, everybody. Have a great,
Absolutely.
safe, and happy holiday
Happy
season.
Festivus to you haters.
A little early for that.
All right, that's a wrap across platform, folks. Do have a good and safe holiday. Romaine and Katie, of course, continuing there on Bloomberg TV, and Tim and I right here on Bloomberg Business Week Daily.
With the year almost wrapping up, time to take a peek into the future and break down Teneo's annual Vision 2026 CEO and Investor Survey. We're going to do that with the co-founder of Teneo when we come back after the break. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. Relatively upbeat end to what had started off as a somewhat concerning week. We had 3 straight days of losses on the S&P 500 to start the week, but now 2 straight days of gains to end it, including a 0.9% gain here on the day. And that's going to be just good enough to push the S&P 500 to another weekly gain, only about 0.1% here. But when you talk about momentum and the idea of investors staying invested and having some conviction heading into 2026, a relatively positive sign as we close out the week. Yields did rise, on the day, but did drop on the week. You're still seeing a bid into haven assets, including silver, which traded once again at a record high. And Bitcoin, we'll just call it, not really going anywhere. It's up 2.6%, but still pinned below 90,000.
Yeah, absolutely. It's been flirting with those levels for a while now. Let's go back to the equity market. These are some of the biggest movers on the day. I wanted to highlight Carnival, absolutely flying, not to mix my metaphors. Shares up about 10% on the day. A totally different story when you take a look at Lamb Weston. We were talking about this a little bit in the simulcast. That profit warning when it comes to French fries, down nearly 26%. And then Invesco higher by 2%. That proxy vote on QQQ, their now ETF, they got the votes that they needed from shareholders to convert it into that open-ended structure. You could say it's just 2%, but Invesco shares higher by more than 50% since mid-July when they filed their plans to do that. We'll get into that more later. But our top story this hour, it's the last full trading week of trading in 2025 coming to a close as investors start to plot out what 2026 has in store. Advisory firm Teneo releasing its annual Vision Survey, which features insights from over 750 global CEOs and institutional investors. Now, the consensus is that 2026 will be defined by steady global growth, expanding opportunities in APAC, and also, Romaine, a robust AI economy.
All right, well, let's get to someone who knows a lot about that. Paul Keary is the co-founder of Teneo and the CEO of the company's 5 business segments globally. Paul, let's go back to the start of this year, because you came in, certainly here in the United States, with a big change in administration and a lot of expectations about what that would mean for business and finance. Now, as we sit here, basically the last week or so of 2025, was this did it play out how people expected?
Yeah, it's a great way to look at it, Romaine. Year over year, CEOs nailed it. On the likely increase of M&A, because it's 40% year over year, you've reported it here very well, that there will be reframing of the regulatory environment, which there has been, that capital access would be there for companies, quality companies that needed it. So all in all, the optimism has transpired in the ways that they expected. I think the issue that none of us were prepared for is just how complex and disruptive trade and tariffs would be. And that is probably the one, to borrow your phrase from your market wrap-up for the week, that's upbeat, but there's some relative upbeat.
Is there any sense that a lot of CEOs and executives see that kind of smoothing out, meaning the uncertainty that we saw around, not even just trade policy, but really a lot of policies coming out of Washington? And it seems like, I don't want to be too presumptuous, but it seems like as we got towards the end of the year, it seems like people at least felt like they figured out the pace of what was coming out of the White House and they could adapt to it more. Is that fair?
I would say it's fair. I also think about it, I think CEOs have to become the chief disruption officers. From COVID through war, through the most consequential new technology history, and then half the planet went to the polls last year, and we've had new governments in many of those countries. So CEOs have had to adapt and learn muscle memory and bring in new models. So I think they're stronger, more resilient, and more able to meet new challenges and disruption than ever before. So I don't think there's any sense that these challenges have gone away, but I think they're more robust management capability to deal with what may come.
Well, you say disruption in 2025, almost 2026. People think about AI, of course. That has been the dominant disruptive factor over the past several years. A bullet point from your survey is that 68% of CEOs are increasing investment in AI and AI spending. Increasing investment, but the return isn't necessarily guaranteed there.
Yeah, this is probably one of the more striking points, I think, when we dig into it. Not surprisingly, it's the largest spend item on the docket for next year for CEOs. And not surprisingly, investors support that. What is surprising is CEOs have more of a decadal long-term view on AI as a catalyst for business transformation. And I don't think investors are there yet. I think they're looking at ROI. I think next year, I think your show, I think the world is going to be looking at how have CEOs wrested the narrative back into how do enterprises change their business models, find new markets, expand their services, and not just for a hunt for efficiencies and effectiveness. And if you're going to transform your business, that takes years, it takes time. It's also, I think, relevant to the point that, surprisingly perhaps, most CEOs are going to hire more people in the first half of next year. And many of that is to hire talent in to avail of and meet the moment that AI presents. I don't think it's a long-term trend you could extrapolate. But it shows that I think that tension between investors and CEOs is real.
Yeah.
But you have to back the CEOs. They know how to build an enterprise through the cycle.
Well, it's really interesting. It reminds me of the conversation around some of the critiques of the quarterly earnings cycle that basically it sort of prioritizes or places a premium on short-term thinking. But to your point, I mean, if you're trying to transform your business, in many cases, that takes years. And, you know, this AI spending conversation or conflict that seems to have risen, it feels like it neatly encapsulates that conversation.
Yeah, we've had this year perhaps of there's the AI and the CapEx AI economy and everything else. I think next year is going to be about everything else, which is how does that technology, how do those investments get harnessed into transforming businesses? And this year and last year was about how do you use this new transformative technology to derive efficiencies, effectiveness, cost out perhaps. You know, that if this year was about AI and the CapEx economy supporting that, next year will be about how the enterprises are transforming with AI as the catalyst.
I have a couple questions just on the policy front, particularly here in the United States, because we are going through another election year, a midterm election year that could actually have some huge ramifications for some of the policies that have already been implemented, plus some of the proposals here. Do the CEOs, do they worry about that as much as they do sort of the presidential election cycle? I know it's just, you know, individual congresspeople and senators getting elected, but if in aggregate it can have an impact on policy, when do they start to pay attention?
I think CEOs today have the dashboard on a range of issues that probably historically they may not have had to have. Geopolitics, global regulation, sentiment around political changes, war, new technologies. There isn't an issue that I don't think that they're not ready for. And they haven't got a team of people modeling out the implications of option A, B, or C taken. As we sit here today, we still think that the Supreme Court will rule on the president's trade and tariffs. There's no company that we advise in our 40 locations around the world that isn't thinking through the range of options that might happen. You can extrapolate that out to elections next year, to elections in this country and overseas. So I think that chief disruption officer crown that the CEO wears is real, and that's here for good, I think, too.
Well, Paul, we started this conversation talking about the relative optimism, relative upbeatness that CEOs feel right now. How might that translate into the M&A landscape in 2026? It feels like we saw deal making come back a bit in 2025 finally, and you think if CEOs are feeling pretty good about the state of things, that, you know, they've got sorted through a lot of maybe some of the boogeymen of 2025, does that translate into increased deal making?
Yes, I think you've covered it very well here today over the last number of weeks across strategic commodities, across technology, across industrials. Our survey shows that, you know, people are loaded for bear in terms of maximizing M&A opportunities next year. And the second half of this year, I think, shows that has been the promise of M&A this year has transpired. So across the sector, capital doesn't seem to be a challenge for strong companies. Ambition is there, and, you know, this consequential moment of AI means that every industry, I think, is subject to rationalization, consolidation, or M&A.
Absolutely. Paul, great to get some time with you. Really appreciate you stopping by. That is Paul Keary. He is co-founder and CEO over at Teneo. Now coming up, SpaceX's IPO plan, pushing an obscure fund into the spotlight. We'll discuss next in our weekly ETF wrap. This is The Close on Bloomberg. A niche ETF propelled into the spotlight as investors race to grab a sliver of SpaceX. The ER shares private-public crossover ETF, the ticker there, XOVER, drawing attention as it holds a small piece of Musk's rocket company through a special purpose vehicle. Joining us now for this week's ETF wrap is Bloomberg's Emily Graffeo. First off, Emily, we have to start with the fact that this has SpaceX exposure, not something that a lot of folks who know generally about ETFs would expect to be possible. Talk us through how this actually exists.
So this fund bought through a special purpose vehicle. They bought a slice of SpaceX about a year ago at this point, and then they added to that exposure. So as of January of this year, they had a 12% weight to SpaceX. The fund has gotten a lot bigger, which we can talk about. So that's diluted the holdings a little bit. But we actually don't quite know that much more about the details of how exactly this little-known ETF was able to even structure this special purpose vehicle and get access to arguably the hottest private company in the world. The issuer's ER shares. So Joel Schulman is the face of this ETF. He's a professor at Babson College and kind of more in academia.
So, and he doesn't have any there's no direct connection between him and Musk or any of his other properties? It's just,
if there
just totally random?
We have not found out yet.
Okay.
But he said that he doesn't want to disclose the exact secret sauce here of what the connection was, but that's what we know so far.
It's interesting, you mentioned the inflows, and this fund now has more than $1 billion in assets, I believe. And it really speaks to the fact that this is potentially a hot IPO and investors just scrambling to get any sort of sliver of exposure.
Yeah, so the fund has taken in about $1 billion just in the last few weeks after Bloomberg News scooped that story that SpaceX is nearing an IPO potentially very soon. What's interesting here is that it's really showing us the limits of putting a private investment into something as liquid as an ETF.
Right.
Because unlike other types of funds, as you know, Katie, you can't cap the investors. So like a mutual fund, depending on the strategy, if it gets too big, you can block investors from getting in. With an ETF, you really can't do that. So it's getting bigger and bigger. More investors are piling in, and it's diluting the percentage. So right now, it only has about a 3% weight to SpaceX, and the fund's top holdings, NVIDIA, Meta, Maple Bear, which I hadn't heard of, Affirm. So it's more of a tech ETF, but people want to get their hands on SpaceX. So even, I think, a small allocation is something that investors are getting excited about.
Absolutely. Emily, I really appreciate you giving us the context here because it's a fascinating ETF story. That is Bloomberg's Emily Graffeo. And for more ETF insights, be sure to check out my newsletter. It's called ETF IQ. You can find it at bloomberg.com/ETFIQ newsletter.
Well, speaking of SpaceX, some breaking news right now on Elon Musk and his pay package at Tesla. What has been a multi-year fight with the court in Delaware over that has now effectively been ended. We're learning right now that Musk's record pay plan at Tesla has been reinstated by a Delaware high court. The court overturns a judge who had said the compensation plan was flawed. Remember, this goes all the way back to 2018 when a shareholder had sued over a previous pay package, Katie Greifeld. Since then, that pay package has actually increased, and now we're learning, and this is more perfunctory, but the Delaware court has now, the high court, I should say, has signed off on it.
Yeah, not much reaction in Tesla shares after hours, probably because now we're talking about a pay package that's even higher than this. But this really sort of soiled the relationship between Elon Musk and Delaware. We know that, he took his business to Tesla, or to Texas, rather. And this was one of the big reasons why. So it's interesting to see this headline cross, that the Delaware High Court reinstating that pay plan.
Yeah, and it was kind of interesting, too. And we should point out, this specifically relates to the stock-based portion of that pay plan, and at least what the original valuation was, which is about $140 billion. Obviously, this new almost $1 trillion pay package, which is based on a variety of incentives he has to hit over the years. That kind of supersedes this to a certain extent.
Yeah, really interesting.
Yeah.
And of course, this was a big catalyst for Tesla shares. Again, not really moving too much after hours.
Yeah, although we should point out a little bit earlier this week, you had Tesla hit a record high for the first time in a year here. A lot to talk about here as we wrap up 2025 and push ahead to what investors will have their eyes on in 2026. Stick with us. Katie's not going anywhere. We'll be back in a moment. This is The Close on Bloomberg. We want to go back to the breaking news involving the files of Jeffrey Epstein. Of course, he is the financier and convicted sex offender who, of course, died in prison before we can learn all the details of the enterprise that he's alleged to have operated. A cache of files, hundreds of thousands of pages, are now starting to be released. This after a law was signed by the president just last month mandating the release of those files. Megan Scully joins us right now. She's a Bloomberg reporter, and she's been helping to parse through the files, and she joins us right now from our Washington bureau. And Megan, first I want to start off with the idea of exactly what is being released today, because I was under the understanding that we were supposed to get the full cache of files based on the way the law was written. Is that what we're getting today?
Absolutely. We were supposed to get the full cache of files. The Deputy Attorney General, Todd Blanche, said earlier today that we would only receive part of it, hundreds of thousands of pages. He said, at this point, it's not looking quite like it's in the hundreds of thousands of pages, but we're still going through the documents at this moment. Now, they are expected to be dribbling out more detail, more documents in the coming days. These include pictures, videos, court documents, grand jury documents that have not yet been seen. But I can say in our initial 30 minutes or so of going through these documents, there are a lot of redactions. Of course, the law provided some exceptions, including to protect survivors. But I can say there are a lot of things in here that we are not able to say.
Well, with that in mind, is this really going to satisfy those who pushed for greater transparency when you consider the fact that you do have all these pages blacked out?
So we're already hearing from congressional Democrats that they're going to explore every legal option possible to get these files. That was earlier today when we learned from Todd Blanche that they wouldn't receive all of the files. I'm sure that this sets up a court fight, an ongoing court fight for the months ahead. This is definitely not an issue that is going away anytime soon. It will be fought. It will be a heavy political fight leading up to the midterms in particular.
Have we heard at all today, Megan, from the White House on this? Of course, the president himself, while of course we know that he has had a long-term relationship with Jeffrey Epstein, he has been adamant that he was not aware of any of the crimes, particularly the sex offenses that Jeffrey Epstein was either convicted for or alleged to have committed.
So most of what we are hearing so far today, and I'm just going to pull up, we have some information from Todd Blanche, but most of what we're hearing today is coming from the DOJ. Of course, the president is speaking tonight in North Carolina, so he may have more to say there. But the Justice Department is saying some 200 attorneys went through these files to determine what was able to be released and what was not. The process, Blanche said in a letter to Congress, resulted in over 1,200 names being identified as victims or their relatives. So that gives you some sense of the scope of the number of names involved in these documents.
Absolutely, Megan. And, we're seeing this release about 11 months ahead of the midterms. What does this mean potentially for, of course, the Republican Party, but also for President Donald Trump? As Romaine mentioned, a long-term association with Jeffrey Epstein, and this has really been framed as another big headache for him.
Absolutely. So as Romaine has said, Trump has disavowed any knowledge of any of the sex trafficking, any of the Jeffrey Epstein, his activities, his illegal activities, certainly over the last 2 decades. So, but it does certainly cause a problem. It already is causing a problem for the president in terms of creating fractures within his own party. He's had a very public dispute with Marjorie Taylor Greene, one of his key acolytes on the Hill, who's actually resigning from Congress next year over this matter. Of course, Marjorie Taylor Greene has pushed for full accountability on the Epstein matter, as have several other Republicans, including Nancy Mace and Thomas Massie.
All right, Megan Scully, one of our Bloomberg reporters down there in Washington. And just to really stress this point, we are being extremely careful here about these documents. We have a team of people pouring through them to parse the content and any sort of new information. We will bring that information to you as soon as we get them. There will be full coverage of this at the top of the hour. Our team over at Balance of Power, they will kick off right at 5 p.m. Eastern time and hopefully bring you some more details on this. But all we know right now is that that cache of documents that were required to be released by that law that was signed by President Trump, investigative records, flight logs, travel documents, immunity deals, etc., related to Jeffrey Epstein, those files are now being posted by the Justice Department. This is Bloomberg. All right, it's been a year for most of the big stocks out there, but really none wilder than for Tesla. The share is trying to get their mojo back after being in the dumps for quite some time, as the company now actually starts to put a bow on a lot of the long-standing issues that have overhang over this company. That includes the pay package for Tesla's leader, Elon Musk. And we just learned a few minutes ago that a Delaware high court has now overturned that ruling related to Elon Musk's pay plan that would effectively constrain what he was allowed to make. And this brings an end to what has been a 7-year legal fight over paying now the world's richest man. Jonathan Levin joins us right now, Bloomberg opinion columnist, to talk a little bit more about this. And Jonathan, Musk put up a big fight for this. You go all the way back to, 2018 or so, that first lawsuit filed over what was then a pay plan of a couple $100 billion. Now it's a pay plan of potentially $1 trillion here. Does this kind of clear the deck for Tesla and more importantly for Elon Musk to just kind of go forward now?
It's absolutely wild, and it's totally unclear to me initially what this means in light of the new pay package. But it just goes to show what a wild story Tesla is to me. I think we're going to get into a little bit later in this segment some of our outlook for 2026, and it's hard not to think about Tesla when we think about what could go right and what could go wrong in the year ahead. This is such a wild stock, such a wild story, unlike any other on the S&P 500. And, what this tells us, what this reminds us of, is anything can happen with this name. It is, it does not trade on fundamentals. It's just wild.
Well, that's what I'm curious about, too, because we talk about the stock sort of rebounding. It's still only up less than 20% on a year-to-date basis, which for a stock like Tesla is actually not necessarily that good for a stock that typically tends to almost double in most years. But that stock is rising at a time where we're still seeing revenue growth constrained. I think they're actually headed for one of their first down years in quite some time on the revenue side. So what exactly are investors paying for here?
As always, they're paying for a story. The thing that I find most incredible about Tesla is how Musk has been able to move the bar again and again, and investors continue to be willing to go there with him. We often hear about CEOs setting goalposts, whether it's for AI or anything else, and people will say, well, if they don't get this done, if they don't get robo-taxis done by year X, the market's going to turn on them. But the market has been willing to hang in there with Musk over and over and over. And I don't know where the leash ends.
Yeah, it's going to be fascinating to see, if SpaceX really does come into the public markets, whether, that same sort of treatment that applies to Tesla also applies to SpaceX. But Jonathan, it was a heavy macro week as well. And I'm taking a look at your last two columns. The one that you published yesterday, you talk about how great inflation data doesn't stand up to scrutiny. Your one immediately before that was that the Fed needs clearer jobs data ASAP. We are several weeks removed from the government shutdown at this point. But when it comes to the quality of the data that we're getting from the government, if you want to call it that, it still seems to leave something to be desired, if you will.
Oh, for sure. Yeah, this was a caveat-filled week of data. On balance, at the end, when all is said and done, I think the inflation data in particular was marginally positive. I got to say, for all of the caveats, it just hits different to have core inflation in the mid-twos. And as we always say, inflation kind of is a mind game. And so, you know, there could be some reflexivity to that. The public sees that, you know, these headline numbers are 2.7% for the headline, 2.6% for the core. Maybe we get some momentum off of that. I also say, although what happened in the housing component of inflation is kind of a throwaway, you know, the breadth of disinflation is really pretty strong. Most of the index is now inflating at something with a handle or lower. And that just feels like a vast improvement from where we had been.
Well, can you talk to us about what actually happened about when it comes to housing, when it comes to shelter? Certainly it was a hot debate in certain circles on social media, but I wonder what you make of what actually happened there.
Yeah, well, okay, so the thing is that we missed a month of data. Obviously, the BLS was not working for the month of October, and so we missed a month of data. And the speculation is that the BLS sort of just carried forward the September number into the following month, and so we effectively got a goose egg for October. And so we can expect that that sort of artificially low impulse from housing to actually carry over for a number of months, the way this figure is calculated. So yes, you put a big asterisk next to this number, but here's the thing. I'm also not concerned that housing inflation is a major source of inflation going forward. As it was, there was already kind of a reason to carve the housing piece out of the thing. And so the fact that that flattered the number does not make me reflexively say, oh, well, I guess the real number is bad. I think the real number is actually pretty darn decent.
All right, so an asterisk, but maybe not one to lose any sleep over. Jonathan, really appreciate your perspective as always. That is Jonathan Levin of Bloomberg Opinion. Meanwhile, let's take a look at shares of Oracle closing the day a little bit higher, with TikTok saying it's been bought by an Oracle-led group. Now this, as TikTok parent ByteDance is on track to reach around $50 billion in profits this year, capping a record year for the Chinese social media leader. Joining us live to discuss is Bloomberg's Kurt Wagner, who covers all things TikTok. So talk to us about this TikTok deal. The news breaking this morning that TikTok is saying that it signed agreements for a new U.S. joint venture. What's the current lay of the land?
Yeah, well, this deal is very similar in structure to what we talked about back in September. You may remember the Trump administration came forward, said, we have these buyers for the company. There's going to be a mix of both new and existing ByteDance investors who are going to now have an ownership stake in the new U.S. spinoff of TikTok. And at that time, it was framed as a potential deal because nothing had been signed and we were still awaiting sort of sign off from officials in Beijing. Well, what has happened now is that ByteDance has signed these agreements with these various investors, and they're out telling employees that this deal is going to happen and is done. I presume that means they have received some type of thumbs up from folks in Beijing that they're okay with a deal like this, but we are still sort of waiting for that formal regulatory approval out of China. But it seems as though all systems are go here for this deal, which again mirrors what we saw originally back in September.
Kurt, based on what we know publicly, does this truly resolve some of those national security issues that ostensibly sort of kicked off this whole process?
I think that's the major question that still lingers, because in September, when this deal framework was first announced, the criticism was, well, look, ByteDance still has some type of role in this new U.S. version of TikTok. They will own just under 20%. There was a discussion at that time about them licensing their content algorithm to the new U.S. TikTok. None of those things seem to align with what the law says, which is that ByteDance cannot have any operational role in the U.S. version of TikTok. We have not really seen anybody come forward and actually fight this yet. We have seen people complain this doesn't follow the law or say that it shouldn't go through, but no one is actually fighting it to this point. So we'll have to see if any lawmakers in the U.S. step up and try to do that. But there are certainly questions about whether this follows the letter of the law.
Well, Kurt, what I want to know as a power user of TikTok, unfortunately, is whether or not it coming under the ownership of this group of buyers led by Oracle, is that going to change my lived experience on the app?
I think it will. We don't know exactly how, but they do plan to retrain that content algorithm. So again, under the proposal, the new U.S. version of TikTok would license the current algorithm from ByteDance. They would retrain it, rebuild it using U.S. specific data, and then deploy it that way. Well, it's possible those experiences will be so similar you won't even be able to tell a difference as a consumer. But these algorithms are very finicky. They're very particular, and so it's possible that the new algorithm will show you different things than you're used to seeing. It may take some time for you to sort of let it know what your preferences are. So I imagine people might notice a slight difference, but we won't really know until we get our hands on it.
I'll be able to tell.
Yeah, Kurt, I want to ask you, for those of us who aren't on TikTok, whether this will lure us back, but maybe I'll just stalk Katie on there. Kurt, always a pleasure. Kurt Wagner over at Bloomberg News, of course, one of the most read stories on the day here, and potentially maybe an end to the whole saga over TikTok and its ownership. When we come back here on The Close, we're going to talk about beauty, and specifically clean beauty, with the pioneer in that space, Gregg Renfrew, joining us and talking about her brand as it makes a big comeback under a new name. You don't want to miss that conversation. It's coming up next here on The Close. This is Bloomberg. All right, clean beauty. It's been taking over the world, topping holiday gift guides, making waves in Washington, and with the FDA included, recently pulling a proposal to regulate the use of talc in cosmetics products. Our next guest, she's a pioneer in that space, and now making a bit of a comeback, buying back her brand from private equity last year and relaunching it this year under a new name, Counter. We're talking about Beauty Counter, now Counter, and the founder and CEO joins us right now, Gregg Renfrew. Gregg, great to have you here on the program. I do want to kind of start off. I mean, you sort of came out of the gate big with Beauty Counter. You had that partnership with Carlyle. I know it didn't work out. You managed to buy back your assets, buy back the brand. You're at the helm of this company once more. I am curious as to what more you need to do to get things back to anywhere near where they were, a few years ago before some of the issues cropped up.
With respect to the company or with respect to the industry at large?
To the company, please.
The company, I think that really we just need to get our story back out there. Right now we're really focusing on engaging old clients, introducing ourselves to new clients, reminding them why the work that we do is important. It's really a game of awareness and getting people to understand why we're here again and why this work really is important to us.
What does competition look like now relative when you first started the predecessor to Counter way back when? I assume there are a lot more entrants in this space that you're dealing with than what you were seeing in the 2011 or whenever.
Yeah, well, when we launched in 2013, we created the entire clean beauty movement. We pioneered it. We coined the phrase clean, and we created that. And we created it as a movement for change within an industry that was outdated and in much need of sort of market disruptors. I think today you have many brands who are trying to be clean, claiming to be clean, and working towards that to protect the health and safety of people. So there's a lot more competition, but I don't think there are a lot of people that are actually walking the walk and focusing on educating consumers, advocating for cosmetic reform, and providing high-performing, safer solutions.
Well, Gregg, something also I think about a lot is the difference between skincare and beauty. And with this focus, of course, on clean beauty, I feel like you sort of toe the line between both. But I mean, would you describe yourself as a skincare company or as, a makeup and a cosmetic company?
I think that I would say we are both. We've always been focused on providing safer solutions, high-performing products in the areas of skincare, color cosmetic, and personal care products. I don't think it's, when you look at the average person on an average day, they are doing everything from putting on, skincare, they're brushing their teeth, they're putting on skincare, they're putting on sunscreen, they're wearing makeup, they're putting lotion on themselves. And so all those things really matter to us.
And, Romain mentioned that the competitive landscape has shifted a lot just in the last couple of years. So, too, has the social media environment. And, think about, we were just talking about TikTok. I spend a lot of time on TikTok, and it's just an inundation of all of these different brands coming at you. And I wonder how you're thinking about that with the relaunch at Counter.
I think that TikTok is certainly an important medium through which we can tell our story. I think that from a shopping standpoint, we've really been focused today on being direct to consumer, to owning and controlling that customer experience in the early days of Counter. I think that it's a place where people seek information, and I think that we are a brand that has been based on transparency and authenticity since day one. But as a company, we're really focused on the power of our community-based commerce model of really speaking directly to our clients and creating an ecosystem of creators, people who are representing the brands. And that may end up being on TikTok someday, but right now we'll use it more as a content engine versus a place where we're doing commerce.
I do have to ask you, Greg, about just the regulatory environment in Washington, some of the changes that have been made this year when it comes to oversight of the healthcare and, for that matter, the beauty sector. And I am curious about the issue of trust. When we talk about clean beauty, and you kind of reference this idea, there are a lot of competitors out there, not necessarily competing, but certainly marketing themselves as clean beauty. How do you develop enough trust with the consumer? And more importantly, how do you develop that trust in an environment where there are a lot of forces working against that messaging, even potentially the government itself?
Well, I think that it's one of the things that's really challenging for consumers in today's marketplace. And really, when I started the company, I started the old company because I really believed that there was a need to protect the health and safety of people. And our skin is our largest organ, so what we're putting on it every day actually matters. When I look at the landscape today, I think about the fact that there are a lot of people claiming to be clean or claiming to be eco-friendly and all those things, but they're not necessarily walking the walk. At Counter, we look at 23 different endpoints to see, are these things safe for human health? Are the ingredients being ethically and responsibly sourced? And I think that, as two examples, and I think that as consumers, look at brands, they need to know, are the brands just claiming something, or are they actually doing the work? And we're actually doing the work. And clean requires a lot of really hard work.
All right, Greg, really appreciate your time. That is Counter founder and CEO Gregg Renfrew. Really interesting conversation on this Friday. Yeah, on this Friday, the last full trading week of the year. Don't forget, next week, a holiday shortened week, Christmas in the middle. And of course, you have a shortened trading session the day before, right, on Christmas Eve? I believe so. Yeah. So are you going to be here? I will be here. Okay, I won't. So have a Merry Christmas and stick around. Balance of Power is coming up at the top of the hour.